Hi guys, my name is Arthur, and in today's video, we're going to be answering a question that many small business owners have, especially those that are still doing their own bookkeeping and accounting by themselves. And that question is, I recently just made a big purchase for my business. Should I mark that as an expense or capitalize it on my financial statements? Now, capitalize basically just means, should I mark it as an asset on my balance sheet? So the question is, should I expense this on my profit and loss or mark it as an asset on my balance sheet? And luckily, I have kind of a clear answer for you, but I'll break it down in just a little bit. My name is Arthur. Like I mentioned, I'm a certified advanced pro advisor in QuickBooks Online, and I'm also the owner of S&G Bookkeeping, an accounting and bookkeeping firm that works with small business clients all across the US to streamline their bookkeeping and accounting. Now, before we get into the financial rules and regulations when it comes to this, whether we should mark something as an asset or an expense, let's talk about why it's even important to make this distinction in the first place. There's two main reasons for this. Number one is that you want to make sure that all of the assets, now essentially assets are things that you purchase today and provide value in the future. So for example, if you just bought a new office computer, that's something that you purchased today, but it might provide value for the business over the next couple of years, because obviously you can use it to run marketing campaigns, respond to customer questions, and so on. So obviously that's something that's valuable for your business. And you want to make sure that your balance sheet, the financial statement that shows all of your assets, liabilities, and equities, you want to make sure that that sheet properly reflects all of the valuable things that you have in your business. So like I just mentioned, that computer setup, for example, maybe you just bought some office equipment, some new vehicles for the business. All of those add value to your business, right? And we want to make sure that we're properly reflecting that, so that when, for example, if we're going to a bank to apply for a loan, that bank can see, yeah, this business does have a lot of assets. It does have a lot of valuable things that can provide even more value in the future. They're more likely to repay this loan compared to someone that doesn't have as many assets. So we're probably going to grant this loan since we know there's a good chance it's going to get paid back, right? So that's one of the main reasons. Number two is you want to make sure that under accounting principles, you recognize expenses in the period that you use whatever you're buying. So in this case, it doesn't make sense to expense that computer immediately if we're going to be using it for, let's say, the next 3 years. That's when depreciation comes into play. And we want to mark that depreciation expense, which is, if you haven't heard of depreciation, it basically just tracks the reduction in value of those valuable things, those assets in your business. And you want to track that depreciation over time. So if we're going to be using that computer for 3 years, we should be tracking that expense over 3 years as well. That just makes sense under accounting principles, not immediately right away as one big expense. So now that we have a little bit of information about why it's important to keep track of all this, let's break down the financial rules and regulations about how you can actually make this decision. Now, obviously, the majority of these little regulations will be coming from the IRS, since they're in charge of collecting our taxes as business owners in the USA. The IRS has what they call the de minimis safe harbor election, and this allows small business owners without applicable financial statements to immediately deduct expenses up to $2,500. Now, applicable financial statements basically mean they're statements that are sent to the SEC, the Securities and Exchange Commission, and they're mostly for bigger businesses that have a higher chance of getting audited. I'm not saying small businesses don't have to worry about this at all, but in most cases, small businesses do not have applicable financial statements. So that's what the IRS calls AFS. So this 25 threshold is what most small business owners have to keep in mind. Now, what this means is basically any item or invoice up to $2,500 can be expensed immediately for your tax return. Now, what this means is any item or invoice up to $2,500 can be expensed immediately. Typically, anything over that is capitalized. Like I mentioned, it's just added as an asset to your balance sheet. Now, you should keep in mind that this $2,500 threshold does not apply for land or inventory, because those will always be assets for the business. So even if you spent less than $2,500, those are always going to be marked as assets on your balance sheet. There is some nuance to this, because business owners can basically have an internal policy with a different capitalization threshold. So what that basically means is that's the cutoff where we're marking an expense as an asset. So let's say, for example, a small business has a capitalization threshold of $1,000. If they buy something for $1,500, then technically they could still mark that as an asset on their balance sheet rather than an expense, even though it's lower than that $2,500 threshold set by the IRS. Now, you can only do this if you have this internal policy in place and you're applying it consistently to every single purchase that the business makes. It's not something that you can just do one time, say this time it's an expense, next time I spend $1,500, it'll be an asset. No, you have to keep that consistent between your business. Now that you have a better understanding of the de minimis safe harbor election and how it works, you should also know that you have to elect to use it when you're actually filing your federal tax return. In order to do so, you have to fill out the statement titled 1.263A-1F, the de minimis safe harbor election. Now, I have no idea who comes up with these names, but that's the name of the statement that the IRS wants you to file, just so they know exactly how you came up with your final taxable income and that you stayed compliant under their rules as well. So this will help you avoid any issues in the future. So when you are filing for your taxes, whether by yourself or with a CPA, make sure that you've attached this section as well. I know that dealing with all of these laws and regulations, especially with the IRS, is definitely a little bit tricky. So if you have any more questions, drop them in the comments below. We'll get back to you as soon as possible. And as always, thank you so much for watching.